House prices continue to fall in August for the 5th month in a row. In this video, I'm going to break down each capital city in Australia and see what markets are the winners and what markets are the losers. If you thought property prices in Australia falling was a mathematical impossibility, think again. Let's get into it. If this video brings you value, please like for the holy YouTube algorithm and comment your thoughts below. Do you think that property price falls will accelerate, or do you think and still believe that property prices double every 7 to 10 years? And subscribe for more property market updates, the Australian economy, personal finance and investing. Let's get into it. The latest housing data for the month of August has been released, revealing how much property prices have risen or fallen in each capital city. Australian house prices in the month of August fell 0.4%, but there is beginning to be a big divergence in the capital cities, with 3 recording increases. Sydney recorded a fall of 0.5%, which is due to the low stock of the market, but it'll be interesting now that we're heading into the spring selling season if those listings do rise and if pressure on prices increase. Brisbane saw a modest fall of 0.1%, again due to low stock, and also Brisbane is more affordable compared to Melbourne and Sydney, and I have heard of people in Melbourne and Victoria thinking of moving to Brisbane after the lockdown. Adelaide and Perth had no change at all, remaining flat, while Hobart saw a small gain of 0.1%, again due to the more affordability in Hobart and low stock on the market. Darwin was the best performing capital city, increasing 1%, and I think this is due to Darwin's low medium house price, which is only $393,000, the lowest in the country. And can you guess it? What was the worst performing market in Australia in August? That's right, Melbourne. Melbourne continues to fall, down a whopping 1.2% in August, even with the low stock on the market. Head of Research CoreLogic Tim Lawless said that the factors in Melbourne were due to the worsening situation with the lockdowns in stage 4, and also due to no migration of wealthy migrants to come in and bid up those expensive property prices. Since the declines began in Melbourne, prices are down 4.6%, and if this rate of decline continues or accelerates, we could see declines of up to 20% just in 12 months, beating the myth that property prices only go up. Regional markets, like expected, held up better than the capital city markets, with no change in August. Regional markets have performed better, as we expected, than the capital city markets, where there was no change in the combined region prices in August. However, over the quarter, it is down 0.2%, but the combined capitals over the quarter are down 2.1%. As expected, the reason for the regional markets performing better than the capital city markets is obviously right now people don't want to be in high density areas, people want more space, people can work remotely, so they're more likely to go regional because they don't have to do that commute to work, and it's more affordable, and like I said, they can get more space. So even though the falls besides Melbourne don't seem so scary, a catalyst is on its way. The only thing holding up the other markets at the moment is the low amount of listings, and we are heading into the spring selling season, which typically sees the amount of listings rise, and this is going to be the real test of the market. Not only this, but we're going to see a lot of stimulus that the government has announced, like JobKeeper, JobSeeker, and the 6-month mortgage repayment holidays will have to have their customers checked in by the banks to see if they can start repaying or not. After September, JobKeeper is going to be reduced from $1,500 a fortnight to $1,200 a fortnight, and JobSeeker is going to be reduced from $1,100 a fortnight to $800 a fortnight. ANU analysis said this could mean 740,000 Australians could fall into poverty, something that we've never seen before. The timing of these two events coming together could lead to a catalyst of increased amount of distressed listings, something you should monitor in your area and the type of property you're after. Keep track of the amount of listings, for example, 3 bedrooms if you want a 3-bedroom, or 2-bedroom townhouses if that's what you're after. And if you do see the amount of listings rise in your area, you can expect vendors will have to start discounting to compete against each other, and we may see discounts increase aggressively. Also, the Reserve Bank of Australia met today to reveal its decision if they will increase or lower the cash rate, and as expected, they kept the cash rate on hold at 0.25%. This is the rate that they lend to banks and to the government, and if that is low, then interest rates will stay low. Finder did a survey with its economists where 57% of them think that banks will have to start increasing their variable interest rates as their profit margins drop because of the huge amounts of deferred home loans. Eventually, those shareholders are going to want to see those profits increase and want those sweet dividends. This could see banks scrambling to find ways to increase their profits by raising variable interest rates on mortgages at a time where many mortgage holders are in stress. A flat cash rate does not mean banks won't increase interest rates. Like we saw in 2016, where they held the cash rate at 1.5% for 34 months, there was actually an increase of interest rates 7 times. And if that isn't enough, national accounts are going to release their data tomorrow, where economists are predicting there's going to be a huge 6% contraction in the June quarter's GDP, gross domestic product, the worst contraction since they started recording the data in the 1950s, and this will make it official that we are in a recession for the first time in 3 decades. So what does this mean for everyday Australians like you and me that are going to be heading into the worst recession in 90 years, and most of us have never been in a recession before, and how can we prepare? So what this means is, although we haven't seen a property market crash yet, the risk is increasing, especially in Melbourne and Sydney, where there's been the most speculation and the biggest run up in property prices. The property market always lags 6 to 12, even 18 months long, because people will hold on to their home as long as they can, and they can't just sell their property straight away like you can sell a stock on the ASX instantly, and prices, in March declined 9% in one day. It was crazy. People will hold on to their properties as long as they can. Then even when they decide to sell, they have to start a campaign, put it on the market for a month or two. Then they have to do settlement, which can take up to 3 months and sometimes. Then we have to wait a month or two for that data. So like I said, with all these supports in place, we aren't going to see the real pain until late or early next year. The only thing holding up the market right now is the mortgage holidays and the low stock on the market, but eventually they will have to come to an end because shareholders will be wanting to have returns on their investment, and they will be wanting those dividends that the big 4 banks are notorious for paying. We are heading into the worst recession in 90 years, and we're going to have the worst contraction since the 1950s recordings began. So if this is not a big enough wake-up call for you to get your finances in order, I don't know what will. And what is truly alarming is the articles that I'm still seeing that are coming out that are luring in first home buyers like lambs to the slaughter, because most of them buy for emotional reasons and not for investment reasons. And those that are taking up the 5% first home buyers deposit scheme right now in Melbourne and Sydney are at huge risk of heading into negative equity and becoming a mortgage prisoner. Now, I can't give financial advice and I don't know your situation, but what I am doing is I've paid off high interest debt. I'm increasing my emergency fund because you cannot rely on the government like we're seeing now. They're reducing the stimulus and it's going to affect millions of Australians. And for any extra cash that you want to preserve your wealth, because what the central banks are planning and what they are doing is mass money printing, which will increase inflation, because the only way the government can pay the debt back now is by inflation, higher taxes. That means what the central banks are planning is, even if they don't have negative interest rates yet, if they can get inflation to 2 to 3% and you're getting no return on your interest in the bank, you're actually getting a negative rate of 2 to 3%. Now, typically what investors do to preserve their wealth and to, combat inflation as a hedge is invest in things like gold, silver, precious metals. Now, it's not financial advice, but that's what typically they do. And also they dollar cost average into index funds like the ASX All Ords or the ASX 200, because if the banks keep printing money like they are, this is going to cause asset inflation like we have seen. Now, this has been a very, very strange recession. We've had the deepest recession and the quickest recession, but we've also had the biggest amount of stimulus ever. That's why Australians are not feeling it now, and they're literally going by their day-to-day lives like nothing is wrong because they've taken out their 20k super, they've got their two $750 payments, they've got their tax return, and they think because there's never lived through a recession before, the good times will keep on coming. Now, I'm still getting many people in the comment section saying the government will save us all, they will save the property market, and I'm sure they will try because there's a big conflict of interest by the government because a lot of the politicians own property themselves. But if confidence drops en masse, no matter what they do, they will not be able to save the market. And even if they can save the market, it'll come at a cost to our future. That money that could have gone into infrastructure for the cities or for the regional markets, that money that could have gone to funding schools, healthcare, research and development, innovation, and it'll increase house prices so your children will not be able to afford a home. Is that a country we really want, where all we do is sell houses to each other, dig holes in the ground to sell resources? You know, that's what they were doing 1,000 years ago. Surely we can do better than that. Now, full disclosure, I own a home myself, and it would benefit me if the government did save me, but I'd rather the government diversify the economy and make the economy more complex and sophisticated than be living in an ancient, economy where all we do is build houses and dig holes. So we have to continue to monitor the situation because things are changing by the day, by the week, by the month. This is truly crazy times we're living in, and I'm very concerned that the amount of Australians are not taking this serious, and I hope that I can save some of those Australians from making some of the worst financial decisions they'll ever make in their lifetime. For all my loyal viewers and subscribers that are still watching, you're awesome. Thank you. It really helps out the channel a lot by watching the whole video, by smashing the like button for the holy YouTube algorithm. And I love chatting with you guys. I reply to everyone, and literally the channel is blowing up. I think the Australian people are slowly waking up to the situation we are in, and we can do this together and wake up everyone and help everyone together. I hope you guys enjoyed this episode, and I'll keep you all up to date. And of course, I'll see you in the next video.